The economy is wonderful, fantastic, and has never been better. That is, if you're part of a small, select group of people. Remember what George Carlin said? It's a big club, and you ain't in it. The stock market, on the other hand, is performing extremely well. We have seen so much investment on all levels, and yet today there has never been such poverty and economic distress. This doesn't end well. You came here for the truth, so let me unveil that for you. Today I'm going to show you several factors that are going on that are so key, so integral, and yet are being ignored because this time is different. That's what they always say. I'm going to show you comparisons between the year 2000 and today. I'm going to show you other factors. I want to talk about the potential, what some are calling the super cycle in commodities. This was very painful. As you saw in 2008, everything was spiking, and that was part of such a disastrous event that took place at around that time, and you know the results of this. This isn't a good sign in which you've got prices rising, agricultural commodities being one of them. Oil, it looks like it's breaking out, and this is coming at a time when you've got so many people. They are in dire straits. And what is the solution? That's right. Give them some money, helicopter money. I'll show you that as well. Some are going to qualify for over 12,000 US dollars. Will other countries follow suit? We'll see. Is the stock market about to crash? Many have been asking this question for a long time, and I'm going to just go over, I'm not going to cover every single thing that's in this article, but read the Forbes article if you have time, because it does break down the indicators, show you the percentages. Look, it's a 12-year-old bull market, SPAC mania, IPOs that more than double on the first trading day. You've got the whole GameStop issue. It certainly feels like irrational exuberance, and it's starting to ring some bells between what we saw in the late 1990s. The current froth is the icing on the cake, and when you look through it, you see a lot of other underlying issues. Remember that. It's not just those little things you could point out, but it's the underlying issues. That's key. Okay, so they do get into more stuff, but there's so much in this video I need to cover, so I gotta move on. But you're looking at the CAPE ratio, okay? Talking about these cyclically adjusted PE ratios. Right now, it's still below where we saw during the dot-com bubble, 35 versus 44, but it is extremely high. And actually, if you break it down and realize, you just get rid of a few ridiculous names, those outliers, it actually starts to look a lot worse. This is the American Association of Individual Investors sentiment, showing you right now that it is far below what we saw during the dot-com bubble, 46% versus 75%. They consider that to be bullish. You look at the VIX index, and a lot has changed with the VIX index, obviously, because of now the admission from the Federal Reserve that they do have a short position on volatility. They'll do anything they can to make sure that volatility remains low. So you'll see things like the VIX index that is absolutely muted. All right. But regardless, it's still higher than where we were back during the dot-com bubble. So a lot different, because the 90s were certainly a time of, I don't want to say necessarily prosperity, but things were a lot better off in many indicators and in many factors than they are today. A lot of people are certainly hurting. And of course, as interest rates have been falling, you've had more and more problems, and they're unwilling to admit that. S&P market cap concentration, horrible today. There's no way to deny that. I can't believe it. But you just take the top 5 names: Apple, Microsoft, Amazon, Tesla, Facebook. They make up 21% of the index total market cap. Back in the day, 18%. Personal savings rate, this one is actually should be looked at a little bit more closely. You see today 13.7%. Nobody's saving 13.7%. My goodness, come on. The average person doesn't have a dime to their name. Back in the dot-com bubble, that was 4.5%. There's another factor here with all the government stimulus that has skewed those numbers, so I think that should be taken into account. IPOs. On the right-hand side, you're seeing the numbers for 2020, and it is truly excessive, going beyond what we saw during the dot-com bubble. There's no doubt about that. The Buffett indicator, you could see comparing what we see with GDP, and you look at the total market cap, comparing the two right now today, it is almost at 200%, and it probably will exceed that. Look at the dot-com bubble, 159. So it's extreme in both cases, but it's even more today. The put-call ratio, we are slightly above what we saw because everybody is betting that the market is going to go up. Nobody's shorting the market today. Very, very few. Margin debt to cash, this is looking very, and if you see it, 172%. Right now, this is excessive on a historic basis. There's no doubt about it. Looking at the Federal Reserve assets, I don't know how, they say it's bullish, obviously, because the Federal Reserve is willing to buy up all that garbage. And you could see right now $7.4 trillion during the dot-com bubble, 600 billion. 600 billion. If you think about it, how quickly they amassed that $600 billion this time around in, let's say, 2020, it was just a fraction of the amount of time that it took to get up until that point. But now they're not even talking about reversing that. And then, of course, they mentioned the federal funds rate, interest rates being extremely low. And the quote that I need to show you is this: the difficulty today is that we have the most interest rate sensitive stock market in Wall Street history. Remember that. It's very clear because the Federal Reserve has to print money to push interest rates down through a process they call open market operations. It's not as simple as people make it seem. I want to cover a few economic aspects here before moving into the stock market. Again, I just wanted to lead with that for a minute. But looking at this is something that I had been talking about previously, and now we're starting to see the articles about it. These people rushed into buying homes, and now they regret it. Hot real estate markets across the US led to a number of buyers snapping up homes without performing due diligence. So they talk about some examples here where people are getting to the homes, they needed to get out, they didn't want their apartments, they didn't want to be in these city centers. They go out, buy a home, they didn't really know what they were doing. The bids were going like crazy. Whenever you have such a hot market, people stop actually going through any of the due diligence, the financing. Oh, we're not going to worry about that. And they're not going to worry about all the other criteria like a home inspection. Why? Because somebody else is willing to remove that from the contract. So if you were to put that in there, they're going to say no. So you got to remove that. This is what happens when you have this hot markets. People start buying, unfortunately, garbage sometimes. And that's what they want. They don't want the person to get an inspection. So it's not as if, well, you pay a little bit more money. No. We don't want that inspection to take place because you want to hang on to their problems. Look, this is just one factor. I think another thing here is that people had moved out of these big cities, but they work, let's say, downtown. And the boss told them, well, you know what? You can work from home for now. But what's going to happen, let's say 2 years from now? There's going to be people that show up to the workplace and you've got others that are working from home or they're working from Hawaii or something. I think that there's going to be a lot of incentive to come back into the office if you want to keep your job. That's just me. That's just what I'm thinking, but we'll see what happens. Bidding wars are off the charts as home listings fall to a record low. You're seeing this all over the place. Big cities. Well over half of all buyers, 56%, are facing bidding wars in their offers. That just tells you what's going on. Red hot markets all over the place. But again, they start to take off these conditions and people run into problems. That's the reason I mentioned this. This article here, which I do not have time to get into it all, is really key. It's talking about what's going on with restaurants. They're opening, they're closing, they're opening, they're closing, and that's what they discuss here. And one of the points I need to make is just in this page, looking at it. If you have time, check it out. It's out of Wall Street Journal. Nearly 39,000 businesses tracked by Yelp closed and then reopened more than once between March 1st and the end of last year, and more than 17,000 reopened 3 times or more. Now think about what that does to the people, does to the owners, does to the clientele as well. And they mention that here. The LA metro area had the highest number of multiple closings. Why? Because they were saying, you got to shut down. No, you can reopen. No, you got to shut down. And of course, that hurts. That hurts the businesses, right? looking at this, repeated closings and reopenings make it tough for small businesses to retain customers and employees, particularly painful for restaurants and brew pubs that must give away or toss out unused inventory and then restock. This hurts. I mean, anybody who's running one of these businesses right now in some of these major cities, I really feel their pain. It's unbelievable. Who knows? Is it going to be the same situation in 3 months? They got to close down again? Nobody knows. Nobody really knows. And to me, this is not going to go well for a lot of small businesses. We haven't felt the worst of it. Quick note here, Air Canada posts $4.6 billion annual loss, capping commercial aviation's bleakest year. So that's what happened, but take a look at what they did. After potentially agreeing to a bailout from the government, we'll see what happens with that, they go out and buy the competition. And then you had WestJet, who's another one of the competition, saying Canada is closed to competition after Air Canada and Transat deal. So they bought this company and they are now one less company out there doing business. They are gobbling up everything. So they get a bailout from the government, use that money to buy the competition. That's the way it works. You say that you lost all this money, but you still got money to buy the competition. It works like this. It's a big club and you ain't in it. Take a look at what's going to happen right here. I mean, this is pretty extreme. We'll see if it goes through. Some families with young children could get $12,800 in relief under the new stimulus plan. I'm interested to see if it actually happens. We'll see all the details as they unfold. But $12,800, depending on your situation, how many children you got and so on. But it would be unprecedented to see this much money coming from the government, taxpayer money, to funnel into different individuals, businesses. Usually this is not looking good over the long term because of the deficits and the debt that all these different programs are creating, but we'll see. This is a chart that's associated with that information. You can just see for yourself. I just put it here if you want to check it out, looking at all the breakdown. The wonderful Janet Yellen had this to say. I thought it was really good here. Let me start from the top here. Secretary Yellen emphasized the commitment of the administration to multilateralism. What are they talking about? Globalization. I love it. They absolutely do. Giving up sovereignty is one of the ultimate goals, and that's to solve global issues, stating that the United States places a high priority on deepening our international engagement and strengthening our alliances. And she emphasized that the time to go big is now. They have pumped more money into the system than they ever have on record, and they're saying the time to go big is now. I'm interested to see how big they really go. All right, switching gears here. Take a look at the quote at the bottom first. People like to make the analogy that this is like 1999, 2000. I think it's different. It's different this time. They always say that. In 99, most of the companies that were going up had no earnings, and that's not the case today. That's what they say. But you see that chart up there? Let me zoom in and show you. It's hard to find a new issue with profits. Top line, S&P 500, and the blue line, percentage of IPOs with negative earnings. Of course, this is the way it's been happening, and we haven't seen this kind of behavior since, guess what? The dot-com boom and bust. A record high in money-losing small cap stocks. Russell 2000, of course, has been going up like crazy. And right now, particularly through 2020 into 2021, this has escalated. And guess what? We haven't seen this level since the dot-com boom and bust. This time is different, they say. What do you think? Let's go through these really quickly. I just wanted to give you some updates on certain topics like this. Largest week of global equity inflows ever. It continues to increase. More money continues to flow in. Another week of record tech inflows. When you break it down by sector, you can see where the money is heading. Weekly bank loan flows have accelerated as well. And then you can see this. penny stock volume has accelerated like we haven't seen in a very long time. That's speculation right there. The next one is the total options volume. More speculation. And the SPY volume has actually declined from a peak that we saw, a few years ago, like end of 2019. This just gives you some insight as to how the money is moving, where it's going to and from. This one here is particularly interesting. Left-hand side, VIX Futures to trade from long ETP in and outflows. Okay, so imagine what's going on with the VIX Futures, and you could see right now, which the VIX is elevated on a historic basis, but in general, it's been rather muted. But people are starting to bet on it. They're starting to bet on the VIX. So we'll see what happens along with that. There's more and more speculation taking place, and I believe people think that there is another event coming, at least as it relates to the VIX. On the right-hand side, you can actually see the UVXY, this particular ETF, call open interest. Look at that. During let's say the last part of 2020 into 2021, it basically just accelerated in a straight line up. We'll see what happens. I'm going to keep my eye on it. My friends in the UK, you can see what happened with the GDP, a story we've seen many times before. It had just dropped dramatically. Haven't seen anything like this. I believe the statistic was something like 300 years. But have no fear, because things are on the up. At least that's what they say. These are the stats directly from the UK government's website. If you want to check it out, they simply tell you that the economy contracted by 9.9%. It's the largest annual fall in the UK GDP on record. Something to behold. There's no doubt about it. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce for free, you want to sell stuff online, you could do that at my website, theamazongps.com. If you want to know about the financial system, top to bottom, I've got everything you need in these 2 books. Check it out at the link in the description. And if you haven't seen this video yet, you absolutely want to check it out. Click it and I'll see you there.